Typically, that means there's a product to market and generating revenue, and we look to partner with companies who want to accelerate their growth through sales and marketing execution primarily. We do use revenue as a proxy to kind of determine what's the stage that we come into, but we are making an allocation to earlier stage investments. Firm's been around for about 30 years. I lead our marketing and technology team. We have 3 other industry sectors: financial technology, healthcare, IT, and enterprise within that is mobility, security, subsectors such as that. We're based in Princeton, New Jersey. We've raised 8 funds, recently just raised our 8th fund this year, actively manage 3 funds, and primarily we put to work initially between $5 and $12 million into businesses, and can sort of double that over time if our portfolio companies require it.
Hi, Elliot Durbin with Bold Start Ventures. We are a seed stage enterprise focused fund here in New York City. Our average check size is right now between $500,000 and $750,000. We've been telling founders lately that we're a first check firm because we focus on enterprise. We have a kind of more specialized knowledge, and that allows us to partner with founders a lot earlier. We're on Fund 3, and really happy to be here. Thank you.
Hey guys, my name is Ali Hamid. I'm a co-founder of CoVenture. We manage 2 funds. One's a venture capital fund, and one is a direct lending fund where we buy securities off of alternative lending platforms. Biggest check we've written is $66 million. Smallest check we've written is $25,000. You know, traditionally it's in like the $100,000 to $200,000 range in what on the venture side, in what's considered mostly pre-seed.
Kingdom Partners, we're an early stage technology venture fund, about 1/3 in life sciences, 2/3 in tech. The tech side primarily seed Series A and then some Series Bs. Currently investing our 10th fund, which we raised about a year ago, and offices in New York City, Menlo Park, and Westport, Connecticut. And I help run the New York City office.
You have to be so good to get to your 10th fund.
They like the big numerals.
All right, before we jump in, I neglected to mention I'm joined by my colleague here, David Martin, in the back, who runs our life sciences practice, also with Paul Ellis-Lager. All right, so let's jump in. We're going to try to accomplish a bunch of things here today. And I've listed them here on this slide. We want to start by talking about the current state of the market. Anyone with a pulse in the tech industry knows that the times they are changing, and the last months have seen some changes in the market. Their valuations are changing. The IPO market has cooled off a little bit. There's a lot that's going on. I'm certainly seeing it with my clients in terms of their fundraising activities. So we're going to want to have our panel talk about the market as it currently looks. Then we're going to dig a little bit deeper and talk about Series A deal terms. We're going to take some of the most important terms in a Series A raise and talk about those terms and talk about it'll be both educational to help people understand a little bit more about how these deals are put together, and also talk about what deal terms look like today. Then we will talk about advice for early stage companies that are currently contemplating a raise. And then we'll end with some Q&A. We will do some Q&A as we go, although don't be surprised if I do cut things off from time to time in order to keep us moving forward. So for our first topic, state of the financing market, I've just thrown up a few questions here to get the ball rolling. And I guess what I'd ask for our panelists, to the extent you can see those questions, to maybe each take a couple minutes and talk about your view, what the market looks like today, how it's changed over the last year, what factors are driving that change, any predictions. And then if you each want to take a few minutes on that, then we can circle back around, take any other comments, any other insights that you guys have. Any of you is free to pick that one up, lead off.
I'll just go with this. I think, and I probably think this is think differently than most people. I think this is a better year to start a company. Last year was a bad year to start a company and a good year to have a company. And the reason I say that, this is probably more for the founders who are about to be founders or are raising pre-seed rounds. So I think last year, a lot of the funds that traditionally did day 0 or day 1 companies ended up moving up to day 2 companies, and like everyone filled the late seed gap, which wasn't a gap because everyone filled it and became like a late seed mountain. The easiest time to raise capital last year is if you had already raised a seed round and wanted to raise like your second seed round. Like that was sort of the dynamic we felt. And I think that a lot of seed rounds were at a higher valuation because you were investing in companies that sort of looked like seed and sort of looked like they were on a Series A. And so you saw like these 8 pre, 10 pre companies that were kind of past seed, and they were just raising because they wanted to. So I think that was, and now I think that you're starting to see people say, hey, actually there's not anyone investing in these day 0 companies anymore. And so like people like Charlie O'Donnell are doing it, Notation Capital is doing it. So I think that that was sort of a shift, and I bet you will see more and more companies or firms come in and do pre-seed deals. The other thing that probably is the other major shift we've probably seen is the rounds, like they're not as linear as they used to be. So it used to be you raise a seed, a friends and family, and that sort of becomes sort of pre-seed-ish, and then a seed round and then a Series A. And I think that what a lot of firms have found is it's easier to make investments in companies they're already invested in. It's like not new information, but they want to be proactive and ask companies if they'd like to take more money before they go out to market because they figure they'll get better deal terms. And I think that that's sort of started to happen more and more. So those are some of like the general trends. And valuations are down, but I don't think that's anything original.
After you.
Sort of in the under end of the spectrum a little later. From our humble point of view, there is a ton of demand out there, and I think it was a seller's market for a long time as an entrepreneur, which is a great position to be in. And that capital or capital overhang still remains there. Sort of the generation of sort of micro VCs, sub $50 million funds is in an overabundance, and it still is. So there's a lot of actually capital out there. And I think what's interesting to think about are sort of the next 2 steps forward and the implications to your business and its funding needs. Because at our level, there is capital. There's more selection bias in terms of taking time and looking at businesses that get the profitability sooner. But the best companies are still getting readily funded, and they're demanding great terms. So in that regard, there's a flight to quality. There's compression at the higher end of the market that's starting to trickle down. So it's sort of a dislocation that may happen in 2016 in terms of a variety of really interesting assets that are funded that need to figure out where to get their next round. So it's an interesting dynamic probably with earlier stage funds that need to probably double down or have conviction to see them through to the next stage of funding.
I'll second that. The earlier investors that you have, despite the market, should double down on you if they believe in your growth and your vision, right? So that's the criteria for your seed stage investors: conviction and courage, right? Because then it lowers the risk that you're exposed to minor changes in the A round and the B round markets. So where we invest, I'm usually spending my time helping our founders to position themselves for the best possible A round. And sometimes those A rounds, we'll do a $3 million round. We'll put in $1 million of that 3 if we lead. Sometimes there's a board, sometimes there's not. But the terms that I'm seeing at the A round, which is the topic of the discussion, it's either a $5 to $6 million A round, and you're giving up, call it 15 to 25% of your company. Or you're raising a $10 to $12 million A round, and the ownership is going to be a little bit more expensive. Call it 30 to 35% of the company. If you've got a lot of competition on your deal, then you can push that down to 25, give or take on the option pool. We've advised all of our companies to get more cash just so they have more runway to create more traction, be better positioned. But not a whole lot has changed. We're writing first checks. We're more discerning when it comes to what founders we choose to write those first checks in. I think you mentioned pre-seed, and I think I'm going to give up at this point and just say, okay, it's really a thing. Charles and Nick and those guys have done a great job kind of building that kind of classification of a first check firm so that founders can know when to call them and when to find them. There's a lot of seed money, so just, I think to your point again, make sure you've got institutional capital that will double down on you, regardless of whether or not you're raising your A or not. That's primarily the changes in the market. Warren?
Actually, just a qualifying question for the audience. Like, of the people who raise their hands for startups, what percentage of you are in the life sciences healthcare space? Okay, so primarily tech, although there's a couple of on the healthcare side. I think the tech and the life sciences side are pretty different, so I'll confine a lot of my comments on the tech side. And I'll try to be contrarian just to make things a little bit more interesting. I think it's actually a bad time to start a new company right now. I think what we're in for is probably 12 to 24 months of a shakeout in this industry. And what you don't want to be doing is fundraising as a new company during that period of time, because there's going to be a lot of noise out there. If you look at the number of seed stage investments in New York City for the last 2 to 3 years, there's a lot of companies out there. And they all want to raise Series A's, they all have investors. So I think what we're entering into is a period of time where you have seed and Series A companies trying to raise that next round. And that's going to take up a lot of attention and bandwidth among potential investors. So if you're a brand new company, it's going to be difficult. Unless you have a proven track record or such an amazing idea, it's going to be difficult to rise beyond the noise. The one thing that is interesting, and I've told this to all my portfolio company CEOs, is the amount of capital that's available for investing has probably stayed the same. But what has changed is two things. One is the attitude of investors, and we've all become more pessimistic in the last 6 to 12 months. You know, we've had a great run in terms of the bull market for the last 5 or 6 years. That's historically a pretty long time for a bull market. I think all of us were expecting the market would turn, and the market is clearly turning now. So generally when cycles go through this, these things don't change in a couple months. They take a couple years to go from good to bad to better and improving. So there's no short-term fix to this, and I think also we're in an election year, so it's particularly a chaotic environment, and anything that's strange on the politics will impact the economics and economy of this world. So that's number one. The propensity to invest on investors is less now than last year. It's becoming more cautious. And then probably the second point is that all investors have 6 or 7 board seats. Some are doing well, some are not doing well. Our bandwidth, in terms of the time that we spend on existing portfolio companies, is going to go dramatically higher for existing portfolio companies. So even if we love your company, a brand new idea, we just, as on average for investors, you're going to have less time to look at new deals because you're going to spend more time in your existing portfolio companies, either raising new money, cutting costs, selling companies. And that generally is a 12 to 24 month type of process. And I think if you ask any VC, like VCs are very good at marketing ourselves, so we'll always say, of course, we're open for business and we'll look at new investments. But the reality is we're going to spend more time on our existing portfolio companies, which logically means that we have less time looking at new deals. So you should think about that. Whereas a year ago or 2 years ago, where you talk to 10 VCs and maybe 7 or 8 of them are actively investing in new deals, if you go and look at these now, I bet you it's probably down to 4 or 5, because a lot of us are spending more time on existing portfolio companies. This is different than 2007, 2008. I think in 2007 and 2008, when you had the downturn, a lot of the governments had a lot of levers to pull in terms of stabilizing the economies and changing both fiscal and monetary policy to flood the markets with cheap capital to keep things going. I think for the last 6 or 7 years, basically, the governments have used all of that. Like now you have negative savings rates, which is bizarre if you're a classically trained economist. That's just weird. So governments today don't have a lot of levers to pull to be able to jumpstart these economies. So I expect that we're entering a couple of years where the economies are at best flat and probably more likely to be down. And that's going to obviously impact the startup funding environment. Q1 is pretty much close to being closed, and there's really been very minimal IPO activity for venture-backed startups in the tech space, and we expect that to continue. So when that happens, investors are going to become more cautious and pessimistic about funding companies. That's, I guess, at the high level, it's going to take a year to 2 years to cycle through that. So I'm not sure that this is the best, particularly great time to be raising new money for a new company.
I would just add one thing. So I think it's sector specific. We've seen a tremendous amount of strength in healthcare and a tremendous amount of strength in security, and there's market reasons for that happening. The shared, healthcare model from a regulatory perspective is snapping up early stage companies left and right. So it's actually a great place to be, in my opinion. Start a company, security, for obvious reasons. When you have a fear-based model, people will buy when their jobs are on the line. In other industries, yes. I think Warren's comments ring true, but I do think there are some market-tied businesses that are powering right through this right now, which make it pretty dynamic.
So one quick thing on Elliot's point of make sure that you have investors with conviction. I think the best way to sort of protect yourself or sort of get the noise of your existing portfolio is when you raise capital, make sure that you've had a conversation with whoever invested in you of what having more conviction means and like what success means. So like if you sit there and you think that if you get to like a lot of revenue, that means that you should be funded again, but your VC thinks like you need to have positive unit economics and that's what it means, and like you go do one thing and your VC was expecting you to do something else, then you're gonna like still have a VC with a lot of conviction. It was just conviction for the wrong thing. The other thing, I think what you mentioned, you were talking about a bunch of macro stuff. So I agree, but it could have like a bunch of different implications, right? So let's imagine like it's really hard for companies to get funded, so then they want to sell, and then there's more acquisitions, and the acquisitions probably aren't going to be priced the same because debt costs more, and so traditional private equity firms can't buy companies for the same price, et cetera. But you still have volume, and then volume brings up price again and brings more people. So I think there's more net buyers in the market now than there were before. So I think transaction volume will go up, even if it's not the same expected value as before. So I think like, I don't really know how it's going to go. Also, you could say, well, more people want to put their money in alternatives because alternatives are not alternative anymore, right? Because they don't want to be in public markets, which are shaky. So I would say you made a lot of bold statements that are mostly true, but might not have like the same.
Again, I'm trying to be contrarian here.
Yeah.
I mean, I think we're lucky to be living in, doing business in the United States, because if you look around the world, this is probably the best. Like we have 2% growth. That's like gigantic relative to all the other industries which are contracted. Like Brazil's contracting, Russia's contracting, China's slowing down. So I think relatively speaking, this is actually a good place, and there was going to be a flight of capital to this country. And it would probably trickle down to both the PE and the venture capital space. But I think just in general, these are cycles. Like we've had this boom where venture and startups have been so celebrated, both in terms of the media and on television. And that always turns. That always turns. So I think what you'll now come, a year or 2 years ago, we were all celebrating unicorns. Now you have these like facetious magazine covers of dead unicorns on the magazine. So it's just a cycle, So as long as you take a relatively long-term view of this, that's okay. But the problem is that, it's hard to ignore the short-term signals that you get. And yeah, so I'll stop there.
I was just having fun. Yeah.
All right, maybe we can take a couple of questions on this topic of state of the market.
My question is for Warren. How would you, I know you were focusing mainly on tech, can you just give me a 2-minute view on how you would answer that question differently for life sciences?
So we do 1/3 life sciences. It's been great on life sciences the last couple of years. I mean, for a lot of the pharma companies, they've spun off ancillary businesses to focus on core areas. They need to build up, add new drugs to their pipeline. So, and a lot of them have struggled to build their own organic R&D capabilities, so they're resorting to acquisition to fill those pipelines. So that's been great on the M&A side, and then you've also seen an influx of companies that have gone public and raised $70, $100 million to continue their R&D, which is great. I think the question to ask is how long does that last, right? So I think so far it's been great, and pharma companies will still continue to want to acquire and invest in innovative drug companies. We've been tremendous beneficiaries of that. It's great. And I think that will continue for a while, but we'll see how that changes over time.
Another question? All right, well, I guess you guys are doing a good job. No questions. All right, so so we're going to move on now and talk about Series A terms. I mean, there's, and I'll start by talking about the different investment instruments that get used. When we talk about early stage investing, there are 2 or 3 types of instruments that get used mostly. I think a lot of people are aware of convertible notes. That's simply a loan by the company, a loan by the investor to the company that gets converted at a later date to the first institutional round, so generally to the Series A, usually at a discount. It's a simple instrument, it's easy to do, it's cost effective, can be done relatively quickly. It's often used at the seed stage, at the friends and family stage, not so much at the Series A stage. Another newer instrument, but that's gotten a lot of traction recently, it's called a SAFE, Simple Agreement for Future Equity. This instrument, it has many of the features of a convertible note, but without some of the difficulties of a convertible note. It's a payment by the investor to the company, an investment that will be converted, like the convertible note, into the equity that's raised in the first institutional round. Unlike a note, it does not have to be paid back, although I will also say often convertible notes are structured so they do not need to be paid back either. It's usually converted at a discount. It can have a cap like a convertible note, but the fact that it does not get repaid and does not have an interest rate makes it in many ways an easier instrument than a convertible note. So I put these 2 out there, put them on the table. So we've spoken about them, but they're not really where we're going to focus today. Today we're going to focus on convertible preferred stock. That's the type of equity that gets used in most VC deals, and that's what we're going to spend a little bit of time talking about. I'm going to sort of go through some of the fundamentals of these instruments, and then I'll turn it over to the panel to make their observations, talk about what the current terms look like, how those terms may be changing in the current marketplace. So very quickly, to talk about convertible preferred stock. As I said, it's the typical Series A investment vehicle. For those who are not so familiar with it, it's like equity that has some features of debt. So it is stock, like common stock, but it gets paid back before common stock. So when an investor makes an investment in preferred stock, they will get paid back before common stock gets paid back, before the founders get paid back. So in that respect, it's like debt, because it gets paid back before common. But it also gets paid back with a preference, so it can increase the returns to the investors. So in that way, and I'll go into this a little bit more as we go further, in that way, preferred stock, it protects the downside of the investors because it gets paid back first if the company doesn't do well, but it gives them a good upside because it gives them a preferred return. It gives them an enhanced return over common. So it can increase returns. It has protective provisions. It gives the investors certain control over significant company actions, like exits, financings, other significant events. It has a benefit to the company in that it allows common stock to be priced low, so you can have low-priced stock options, which is beneficial when you're bringing on employees. It strengthens your balance sheet compared to debt, and as most people are aware, we designate preferred stock in letter by rounds, by letter numbers. So we're talking about Series A, but as subsequent rounds go out, it'll be a B, C, D, and so on. You guys want to say anything at the outset about preferred stock?
Just a rule of thumb. For really early stage seed or Series A, you know, investors pay more for preferred stock, right? So what's the discount? Typically, and I'd love to get other people to chime in, the common stock or options that employees get or founders get typically are going to be 15 to 20% the price of the preferred stock. So it's a pretty substantial discount. So common stock for employees or founders don't have the protections and some of the bells and whistles of preferred stock. But the trade-off that you would get is that you get much cheaper stock. And if the company actually is successful, you know, your return is actually much greater. So that's just to give kind of an idea, give you a sense of an idea of the differences between the value. So you're not getting some of the protections that us investors are getting, but you're getting instruments that are a lot less expensive, which is more upside if the company is successful.
Yeah, I think kind of to add on to that, so I think that what a lot of founders forget is that they own common stock and they want their common stock to be worth as much as possible. Because like, just if the company sells for $100 million, in some wonky weird case, you might, like, your common stock might be worth $0, right? So like, be pretty conscious of what you actually own and what makes you rich and what makes you not rich. The other thing that I think people get wrong is they hear the term valuation, right? Like, this company raised at like a $50 million valuation. That'd be probably really high for a Series A, right? But it doesn't mean the company is worth $50 million. It means that if you were to assume that every share had all the same protections that the most senior share that was just purchased had, and you aggregated all those together, then yeah, it would be worth $50 million. But in 99.9% of cases, like Uber, for example, right? That's not like a company that's worth $70 billion. If you added up the worth of every single share together, right? It would be as if like the most senior share that was just sold was, you know, similar to every other class of share, and you added those together. So be like kind of conscious of that difference, and that's sort of what it means for you and also for your employees. The other thing that we've seen people run into, this usually happens for first-time founders, is they think, wow, I just sold common stock. That's really good, right? I don't want to sell preferred shares because those have protections. But then you've also like made it really hard on your new employees, or like sort of messed up your options, because all of a sudden it's like really hard to claim that your common shares are not worth as much, and so sometimes there's tax implications or whatever. So, you know, we're acting like preferred shares are bad for you. You know, in some cases they're good for you. It allows you to sell more of your shares at a higher price. It's better for upside, worse for downside. But even in the interim, it's like really bad to sell common shares and put a price on them. You only want like a 409A valuation to put a price on your shares, your common shares at least.
So I'm going to take a awkwardly simple approach to this. So I work with a lot of founders that are forming their cap tables for the first time, and the advice that I give them is very simple. The greater the deviation from standard plain vanilla document that you do, and when I say standard plain vanilla, I mean SAFE, NVCA standard, Techstars note, right? 3 classic sources, is going to cost you. And it's going to cost you in time and money and brain damage for that investor who has to receive that at your next round. If they're not expecting something, they're not used to seeing something, or it's not done in a way that they've done before, they're going to have to spend cycles working through that. And that's going to cost you in all sorts of things. The second thing I would say is, when you're building your cap table for the first time, VentureHacks has a great one, venturehacks.com. And what it shows you is your option pool for employees needs to be allocated at some point when you do an equity round. So if you don't do an equity round and you do a note or you do a SAFE, you get to kind of kick the can on that a little bit, right? But when you allocate options, that's dilutive. And what investors sometimes come in and say is, well, we'd like to replenish that option pool from 5% of stock to 15% of stock. Then the question becomes, well, do we do that pre-money or post-money? It's called the stock option shuffle, right? So there's all sorts of little levers in your cap table that for every deviation from standard are going to cost you as your trajectory increases, right? So keep it as simple as you can up front. And I would never advise a startup not to seek legal counsel. However, there are plenty of standard documents if you're a seed stage first-time cap table designer. Plenty of literature out there.
So I think for any startup entrepreneur out there, like, one advice I would give is get a really great lawyer to advise you who's had a lot of experience on this, because there is a certain amount of pattern recognition associated with this. Or even better, find a serial entrepreneur who's had some level of success the first time around, right? because rarely do you get it right the first time. Like every first time entrepreneur, there's 1,000 mistakes they make, either on how they raise money or how they hired or what they built, stuff like that. So go find someone you can buddy up with. Second time entrepreneur who's done it multiple times, had a bit of success or a lot of success the first time, to be sort of advice for you. I think it's a good way to get objective advice that you can sort of trust. Because there's a lot of painful learnings and lessons learned that you want to avoid. You want to borrow off of someone else's sort of knowledge and wisdom.
Also, attorneys often, like, their job is to protect their own job, and often they're not very commercial, right? So like, in every deal, there's gonna be trade-offs, and it's about finding an attorney, and often that's a good reason to find an entrepreneur who says, look, like, you're increasing risk in the business, or yes, this is like not good for you, but there's other reasons. So finding someone who like kind of gets the big picture, and not just an attorney who's sort of new at a good law firm who's trying to not get fired.
Because a lot of times you get in the heat of the moment of negotiating a deal and deal terms and transactions, like you become very myopic. It's a very short-term perspective. A lot of times you'll end up building these startups for 5, 6, 7, 10 years. So the decisions you make on day one will have implications, to Elliot's point, 2, 3, 4, 5 years down the road. And it's not always obvious. So seek out someone who's actually gone down that path and has made those mistakes, and hopefully you can benefit from that advice.
Just looking a little bit down as you formalize your cap table and you find some great early stage investors, some perspective, 100% agree. The simpler you can set the tone to your structure, sets the tone for the future. So if I'm coming in looking at your deal, what Elliot puts down, I'm probably not going to change up if I'm getting a fair price. And that actually sets the tone for subsequent rounds. Typically, if you press on price, the market is pretty efficient. You'll get within a range of what people think you'll pay for the business. That's when structure comes in, later stage. That can complicate things and all these sophisticated securities that you're hearing about. And sort of the rule of thumb here is that the higher price someone like me or Warren that's later stage pays, the higher the bar, perfect execution is needed to realize the value that we're paying for that stock. And what that means, candidly, is your head's on a platter if you don't execute. So what I just recommend as you think about finding the right capitalization structure and partner is that you set the tone, keep it simple, fairly price it, because you want to grow in and exceed that valuation. You don't want to set yourself up for a down round if you don't perfectly execute. And it's just perspective that looking at these businesses years down the road, if I see some crazy structured deal or a lot of pressure on the price, you know what, rather than me doing the hard work that should have been done a year ago, I'll probably pass, because I don't want to insult the entrepreneur, or I just don't want to deal with all the interests that might not be aligned between the investors and the common stockholders in the company.
Almost like,
Ollie, no, go ahead, but then we'll move on.
regardless of your valuation, the shares you own will probably be worth the same. So your company might have a higher valuation, but your shares will be worth that much less than a preferred share because they'll have more structure. Your company might have a lower valuation, but your shares will be worth closer to what the preferred shares are worth. So even if you think you're bright and like your company's now worth $5 million, the shares you own are probably worth the same either way.
Okay, I want to underscore one thing, a really important point that Elliot and Ryan both made, talking about the cost of letting it get too complicated. Elliot started off and Ryan finished it. The biggest cost of letting your capital structure get too complicated, or your deal term gets too complicated, is that the investors just pass on the deal, because each of these guys has hundreds of business plans that they're looking through, and when they look at one and it starts to get too complicated, they're going to go, "Ugh, life's too short." They're going to move on to the next one. So it's not so much the risk of not getting of getting a worse deal, but not getting any deal at all, if you vary too much from the norm and create too many headaches. All right.
Yeah. So if you don't do an options pool set aside until the A round, you're doing a seed round right now, and in between you want to bring on a senior person and incentivize them, what would you recommend?
So
You can put that into a side letter. You can create an option pool through an employee stock option plan with a note. It's not necessarily coupled together.
Right.
So I think you can actually download one that's compatible with a note on the Y Combinator website. But if you do that, just plan your equity chunks for that executive and then loop it in with your next round of funding and solidify it.
Thanks.
All right. So we're gonna focus in on a few key terms in the Series A deal. Valuation, liquidation preference, protective provisions, anti-dilution, and redemption rights. And before we jump into that, I think Elliot mentioned briefly the NVCA, the National Venture Capital Association standard forms, and it's worth pausing on that for a minute. The NVCA did a great service to the industry by publishing these standard forms that were developed by a consortium of lawyers and investors as a standard set of deal documents for these deals. And they are generally used as a starting point for Series A deals and beyond, certainly not uniformly, but very often. And they provided a template that everyone in the industry, any investor, any lawyer who works in this industry a lot, knows these forms pretty well and is very comfortable using them as a starting point. So it decreases transaction costs. For you who is trying to get your head around this space, there can be some value just to going to that website and looking at these forms, and just start with the term sheet and read through the term sheet. It takes, if you're not familiar with it, it'll take a little bit to get through it, but you can learn a lot from that.
Read the footnotes. It's how I got educated on this stuff. The footnotes are incredible. They explain every term page by page.
All right, so we've touched briefly on valuation. We're going to take a slightly deeper dive. This is certainly perhaps the most significant term in your financing. For early stage companies, valuation is an art, not a science. For more mature companies, there are various methodologies you can use, a discounted cash flow or other techniques that will give you a valuation. But for an early stage company, for a pre-revenue company, none of that is really of much value. What really is going to matter is what value the investor puts on that company. Now, when you think about value, it's really sort of a combination of two elements. It's both company specific, but it's also related to what's going on in the market. For the company, the investor's going to look at several factors. They're going to look at the market opportunity. How large is the market you're going after? What's the rate of growth of the market? What's the competition like in that space? They're going to look at management. The management can be a key factor, for some investors, the most important factor in looking at a company. Who are you? What does the team look like? What are your credentials? What's your track record? A serial entrepreneur is significantly more valuable to invest in than someone who's going at it their first time. Do you have drive? What's your vision? Your solution, your product, is it achievable? Can it be built? Can it be sold? Can it be scaled? Is it timely? Are you getting to the market at the right time? And is it protectable? And then finally, progress. How far along have you got? Are you still, are you still on a napkin? Are you in beta? You got revenues? And where are you at in the process? So those are all company-specific factors. But then there are factors in the market that also impact valuation. Because as we said, investors are looking at many other opportunities at the same time as they're looking at your company. So they want to know what other companies are out there, what their valuations look like, how they're negotiating. And for you, as a startup company, you're talking to other investors. So what's happening in the marketplace, what the competition looks like, is going to help to set the value of your company just as much as your company's intrinsic characteristics. Guys, you want to add something?
When I see Series A, I think one term, product market fit. If you don't have it, you shouldn't be raising an A round. It's like dumping gasoline on a fire that doesn't have any rocks around it, right? It's going to go everywhere. And a lot of the unit economics, the size of the market, proving that you're well-positioned in that market to capitalize against the competition, all the elements of product market fit are evident to folks that do, and I'm sure the A-Round guys here can attest to this or disagree with me, but they'll know it when they see it, when a company's achieved that. And a lot of the art, I think, is as a founder, is knowing when and how to communicate that message effectively. Terms come second.
So I make a comment that there's a big difference between raising a seed and a Series A, like dramatic difference, like 5x harder to raise a Series A. Because with a seed, you're typically making a bet on like a piece of paper. Like there may not be a product, there may not be a team. So sometimes it's actually, for investors, it's easier to invest in something where there is actually no reality and no metrics. It's the dream. Typically when you raise a Series A, there's some, hopefully customers, hopefully some revenues, some traction, some competitors. And that's sometimes it's actually more difficult to raise money at that point because you actually have evidence or empirical data to point to that allows an investor to say no to that investment. So that's number one. And I think a lot of entrepreneurs who have a really easy time raising a seed round suddenly find when they're raising a Series A is dramatically more difficult and takes a lot more time. I also say just at a high level, what's different now, today is very different than a year ago, meaning what was successful a year ago, meaning raising a next round at a 40 or 50% higher valuation, today is probably really different. Like raising a flat round is probably success. So the market's actually changed a lot. So you just have to recalibrate what success is relative to the time in which you're raising money. And I think just like, maybe I'm too pessimistic, but I think, I think there's a 6-month lag for our entrepreneurs. It takes about 6 months to realize, hey, the market's really changed. It's tougher. I need to talk to more investors. The terms I'm going to get are not going to be as attractive. So I think over the next couple of years, what you'll see is in many ways, in the same way that the last couple of years, the pendulum swung very much in terms of the favor of the entrepreneur, with a lot of very entrepreneur-friendly terms. I think it's now swinging the other way, where it's going to be more investor-friendly. So entrepreneurs need to be able to adapt to that new reality going forward.
So I completely want to emphasize that raising a Series A is harder, especially from the diligence side. So Series A investors do something called due diligence. It's something seed investors often forget to do. And it's like the real deal. And the whole like, hey, I have 3 weeks till I'm closing my round shit that worked in Series Seed, like doesn't work in Series A unless you're talking to a third-tier firm. That's like feeling like a bunch of FOMO. So like seriously, take that very seriously. The other thing that I've noticed in terms of valuation that was surprising, and keep in mind like these guys do Series A's all day. For us, it's like probably not as often, but so they might have seen this already. Is more Series A firms, or at least a few, have offered term sheets on a post-money basis instead of a pre-money basis, which is totally wonky. Basically what they're doing is like they're discouraging you from taking money from all your other investors. They're saying, hey, fine, do it. It's just going to dilute you, not us, right? If they do it on a pre-money basis, it kind of dilutes everybody the more money you raise. I don't know, maybe you guys are doing it, maybe not, but
I dealt with one today. Yeah.
So that's different. I think also the other thing is, I think there was like this really smart VC once who must have said, hey, ownership is really important to return my fund. And a bunch of LPs were in that fund and told all their other funds that they should think about that. And then everyone agreed that it was a good idea. And so now it's an overestimatedly good idea. And so firms, well, yeah, like valuations, at least there is some science in the Series A. I think too many funds are still saying, hey, this is how much I want to own, and let's figure out what your price is going to be based on how much I need to own of the company. And if you're, lead investor, don't expect your lead investor to be okay with owning anywhere less than 10% of the company. And in many cases, especially when it's a big fund, if you're talking to like a fund that's worth $1 billion, it's $1 billion fund, you can expect that they'll probably want to own 20% of your business, right? Or at least have a path of getting there over time. Some funds will try to get in and not get as much ownership, and they'll try to take a super pro rata to like get more ownership over time. So those are some dynamics in pricing, right?
Yeah, I would just say, typically for Series A, it probably takes 6 months to raise capital. If you know what you're doing. And then from a term sheet to close, probably 60 to 80 days on average. Yes, we can go faster if the situation requires it. I think a really important question when you sit down with an investor is, what are your return metrics? What's success for you and your investors if they're an institutional investor? That determines, frankly, the valuation discussion. There's market discovery, but there's also a fit you need to find with, you know, their risk tolerance and what you're trying to build and how much you think from a multiple perspective you can deliver. You know, for us, we have a $300+ million fund. We need to deliver over $1 billion back to our investors. We have a specific way and a playbook of how we go about doing that, and that could be completely different from Warren's. I don't know, but the point is, you have to really understand those questions because, you know, we're in these deals with you for 7 to 10 years on average, and that determines valuation as well. And we're pretty cards up when we come in to say, well, here's our assumptions about what we think could happen. It's Excel magic, but we've done 200 investments and have 140 exits. We have some empirical data about what certain companies are worth based on growth and profitability and scarcity value about what they're doing, and we always want to see a multiple expansion, so the price we're paying, we always want to see rise when we're selling if a company's executing well on all those things. And then, you know, on the qualitative side, frankly, just from our perspective, there's 3 things, 1 signal and 2 things we really look for. Growth at time of investment is the highest correlation to success in the future. We've actually looked at all the data from all our companies. All growth is not equal. It's our job to figure out if that's quality revenue, it's sustainable, it creates value long term, and that's where due diligence comes in and talking to your customers. 2 things that we really you know, look for is product completeness, and that you're not trying to transition to something you haven't delivered yet. Usually that's a disaster, and we've learned and lost money that way. Due diligence, again, kind of confirms that, but we always expect you to evolve product over time and put new stuff on the board and diversify. And then probably the most important thing, as Paul mentioned, that was team. We actually have an entire matrix of what we look for characteristic-wise in our CEOs. And surprisingly, it's actually not, it's a softer side that matters. Someone's coachability, they have to have an opinion, they have to be hard-charging, their ability to bring great people and convince them to follow them into the trenches in a high-risk, you know, venture speaks volumes when you sit down and look at their ability to bring good people into the business around them and empower them. But it's also the relationship they want with their financial partner from our perspective that matters a lot. Someone who has all the answers is usually a disaster. So take a hard look in the mirror about like what you think you're really good and bad at, and find people to fill out those skill sets and be really, you know, realistic about what can happen. And frankly, the entrepreneurs that call us the most, not to make us feel good, but just to say, here are all the issues, here's all my problems, lead with bad news first and then follow with good, always have the best outcomes, just qualitative of what we've seen.
I agree with everything you said. The one point on valuation, since we're on this, calculate your effective valuation. You made a great point with the post. Simple way you can tell the spirit of a term sheet. If it has post on the top, it's an aggressive term sheet. If it has pre on the top, it's a really friendly term sheet. Because post means that it's pinning the cap table to fit into its kind of deal without building up on it, right? Post means you have to end up here. So we don't care how you do that, but figure it out. Which usually means squeezing your investors, diluting yourselves, things like that, right? If the need is to have a post on top, calculate your effective valuation. Here's a quick example. You're raising a $6 million round. Investor comes in and says, I'll give you 6 on 18, but I want your option pool to be at 10%. It's at 0 right now. What's your effective pre? It's not 12, I'll tell you that, right? It's lower than 12. So that's the best thing I can say about valuation and how things have changed. The number of times I've seen post on the top of a term sheet has increased significantly over the last 6 months. And there's a way to cure that, it's competition. You can say, well, this is great, I appreciate it, you're a good partner, but this better partner is offering me a pre, so if you can meet that valuation, that'd be great. But
All right. We can take 2 questions on valuation.
with that as well. Jason Mills, Coach 360. We do sports analytics on the mobile platform. What I'm interested in is what you haven't mentioned. You haven't mentioned the requirement for revenue generation at, let's say, either the seed round or even the A round. And in a down market, that tends to be what most investors talk a lot about. But I haven't heard any of you talk about that, which has me interested. But can you talk a little bit about how much you stress on revenue generation, no matter how small, depending on which stage of investment you're trying to raise?
So it's the most useful question for us to answer, and it's the hardest question to answer because it's dependent on companies, right? Like if I told you it's a 100K a month company and they're doing zero growth, then like that's not great. There's so many triggers. I think though the way we tell our founders to think about it is when you raise your pre-seed or initial capital, you're trying to figure out if your customers have any value, and if so, how much value. I think too many companies try to figure out growth before they try to figure out the value of their customer. An example is imagine your customers are worth $100,000 each. You can spend $50,000 going and getting each one. If they're worth $100 each, you can spend $50 getting each one. You have to figure out how valuable your customer is before you figure out your growth strategies. And then when you're raising your seed round, you raise that seed round, and again, you should have this conversation with your investor. I am raising this round to figure out if I can grow and what channels work. And so by the time you go to a Series A investor, that's why they're looking at growth, and then they're looking at like high quality revenue. I see a lot of founders chase bad revenue, which is like either non-repeatable revenue or revenue that's expensive or revenue that's like doesn't have positive unit economics. I feel like unit economics is the most annoying word because everyone uses it now, but it's true. And then I think that the biggest surprise people often find, or entrepreneurs in raising their Series A, is they overestimate economies of scale. They assume, well, my company's been around longer, so more people will know my brand name, so my cost of customer acquisition will go down, and my lifetime value will go up. And what we've often found the big surprise is that actually you hit your customers who are most in need, who are doing anything possible to go find you, and because they were in such need, they had the biggest lifetime value. And what you often find is like there's certain segments or certain growth channels that like aren't sustainable. So a big way we think about raising your Series A is make sure your growth is sustainable, or at least what channels of growth are sustainable. And now I'm getting to the point where I know less than the other guys on the panel talking about that part, but I would think of it in those three hypotheses or things you're trying to prove. If it's a marketplace business, you're looking at GMV. If it's SaaS, you're looking at recurring revenue. So that's why people are annoyed and don't answer that question well usually.
So I'll take the contrarian view here.
Oh man.
So there's certain segments, there's wide variances. Like I would say on average, VCs on the East Coast, specifically in New York and Boston, tend to be more financially oriented than VCs on the West Coast. And we have offices on both sides, so I see this on a daily basis. So a deal that requires revenues in New York City to get done may not require revenues to get done in the Bay Area. So this is very subjective. This is less science and more art in terms of storytelling about your market, your team, your product. So just take that. We'll say oh, you have to have 100,000 in MRR. Yeah, maybe. That's a rule of thumb, but it's not an absolute. So take everything with a grain of salt. That's number one. Number two, in certain segments like enterprise software, SaaS, I think 35 to 40% of the Series A deals that were done last year were pre-revenue companies. So you can actually raise a Series A with no revenues if you have the right team, the right story. So it's hard to give you one answer because I think it's a range and it depends on a number of factors. So you sort of have to show judgment in assessing your own situation, who you're raising money from, who your audience, who's your target investors that you're targeting, because it can vary a great deal.
I can just add to the SaaS enterprise portion of that. I agree. We look at it as pain points. How big is the pain to how rich of a customer? And if I'm able to call up someone and say, hi, do you have this problem? And they go, yes, do you have something? Because I'd like it yesterday. That's a company that I think is going to raise a lot of money, right? Versus pushing into the market, maybe a little less.
All right, we'll take another question on valuation. Okay.
Just one question. From an investor standpoint, what do you look for as multiple from the seed round to the A round? Like, what would you like to see? 5 times, or what makes sense?
For the seed stage, we're focused on following on. The big returns for us come
Yeah.
at the IPO. So we want to own as much of the company as possible, and we're usually in buy mode until then. So whether it's, unrealized markups are tough to gauge, right?
That's absolutely, like, you know, it's, I think the next 12 to 24 months is gonna be a really interesting time among both investors and entrepreneurs. I think we have like 130 plus unicorns. These are companies that are over $1 billion, right? And they probably have like a year to 2 years worth of runway. And they're not all gonna execute. They're all, a lot of them have to raise more money. I can guarantee you, most of them are not gonna raise a valuation. They're not gonna raise an up round, they're not gonna raise a flat round, they're gonna raise a down round. So that just shows you how, you know, these valuations are worth the paper that they're written on. You know, it isn't until the exit, until the M&A or the IPO that you really have a true sense of the valuation. And there's all these intermediate stops along the way, so don't get too, it's not science, it's not written in stone. So don't take it too seriously. Take it seriously, but don't think that it's a guarantee. That's number one. Number two is the valuation, at least for seed or Series A, is oftentimes the least important criteria for making a decision, from your perspective as an entrepreneur. You know, most entrepreneur-investor relationships last longer than marriages. Right? It's like 5, 7, 8, 9 years. Seriously. You will.
Does that say something good about those relationships or bad about marriage?
I'm not going to go there, but I mean, I say that sort of facetiously, but think about it. Like, you're taking an investor, and if you do your job right, you'll continue to build the company, you'll have success. But you'll be, whoever you choose to fill that seat as your investor in that seed or Series A, you're going to be with that person for better or worse, for marriage, for life and death or whatever, for 7, 8, 9 years. So we can spend a lot of time talking about the terms, the valuation, liquidation preference, you know, all these things, and they're important. But I think use the process as you talk to a bunch of VCs, investors, to imagine what it would be like to work with that VC for the next year, 3 years, 5 years, 7 years. Because I guarantee you that at the end of that journey, it will less likely be about whether you got a 7 pre or an 8 pre or a 9 pre. It's going to be more about, did you bring on a partner who you enjoyed working with through both good times and bad times? I mean, I don't want to sound too qualitative and squishy here, but really, that's how I invest now. Like, I used to pay a lot of attention to these specific terms, and we go to war around liquidation preference and stuff like that, but at the end of the day, it's not worth it. Like, you're literally getting in bed with someone else for 5 to 10 years, and you realize that the terms are important, but whether you're enjoying that process, whether you feel like you have a partner and confidant, that's really important.
Yeah, I would add just one thing. So growth cures all sins. So when you sit down with a VC, ask for a referral to CEOs and companies that didn't go out so well. And get connected with them and see how your financial partner managed through a tough time with them, because that is actually the true test of who sits on the other side of the table with you, in my opinion. Because the hit rate in this business, if you're batting 300, you're pretty successful.
All right, we are going to move on, or have to move a little bit faster. Excuse me. Okay, we're going to talk about another significant term, liquidation preference. A lot more difficult to get one's head around than valuation, but very important because it certainly affects how much you walk away with at the end of the day. So bear with me as I try to explain how this works and give an example. Liquidation preference is the amount that the preferred investors get back before the common holders. So we talked about preferred stock, how it gets a preference. So let's throw an example out there and let's keep it simple. Let's suppose your investors are getting a preferred stock that has a 1x liquidation preference. Let's suppose the pre-money value of the company is $3 million. They're investing $1 million, so the post-money value is $4 million, okay? That means they own 25% of the company, all right? So if they have a one-time return, and we're going to keep it simple, this is non-participating, we'll talk about that in a moment. if they have a right to get one time their money back, they have a choice upon an exit. They can either get the amount that they invested in the company, that $1 million, or they can convert into common and get the value that the common gets, or in this example, 25%, okay? So let's suppose things don't go well with that company, and it gets sold, you know, at a bargain basement price. It gets sold for $2 million. The pre-money investment value was $3 million. It gets sold for $2 million. Well, how do those proceeds get divided up? Well, first of all, that preferred investor, they get to get their money out first. So they take $1 million off the top. What's left, that second $1 million, is what goes to common. So although the preferred investors have a 25% interest in the company, because they have this liquidation preference, they actually take 50% of the return in this example, okay? So they're protecting their downside. And you know, that's how it works, and it's not unreasonable. They're putting the money in, but that's how it's structured. But let's look at another example. In an upside scenario, let's suppose the company gets sold for $10 million. So at this point, the investors have their choice. They can either keep their preferred stock and get their $1 million, or they convert to common. And they convert, we know they own 25% if they convert. Obviously, they're going to convert because then they get 25% of the proceeds, or they get $2.5 million. So in this example, we can see how the preferred stock, it protects the downside of the investor if things go badly, but it gives them the ability to share in the upside if things go well. Okay? So now let's complicate the example a little bit, because sometimes the preference will not be a 1x preference, but it'll be, say, a 2x preference. So in that case, the investor has the right to get 2 times their money back before common gets anything. So we'll run this through our examples again. So in the case where you sell the company for $2 million, well, surprise, the investor gets everything and common gets nothing, even though the investor only has 25% on a converted basis. Now, in our $10 million example, it's a little bit different. The preferred investor, they could take their preference, but they'd only get $2 million. If they convert, they get 25% or $2.5 million. So obviously in that example, they will convert. So one of the things you can see is that as valuations get higher, the value of the preference diminishes. So I mean, as Ryan said, growth cures all ills. By the time you're having a huge exit, you know, that preference is going to matter a whole lot less than if things didn't go well. So one last twist on this is what's called participation. Participation is the right of investors to not only get their money back, but also then to convert in the proceeds as if they had converted. So sometimes this is called double dip preferred. You get your money, and then you get your participation. You get the best of both. So to run this example run this principle through our example, let's suppose you have a participating preferred with just a 1x preference. So in our $10 million exit, for example, the investor, they would be able to get their $1 million back first, and then they would get to share in the proceeds as though they had converted. So they get 25% of the $9 million. Okay, so you get your $1 million, and then you get your 25% of the $9 million. That's why it's called a double dip. You get it on both sides. And if you do the math in this example, that comes out to $3,250,000 compared to the $2.5 million that you get in a straight 1x preferred with no participation. So I don't know if I've lost people too much with these examples, but that's a quick education on liquidation preferences. The one thing I'd say is the participation, you can have no participation, you can have full participation, or it can be capped. So that when returns get to a certain point, the participation goes away. I think the takeaway here is you gotta understand your liquidation preferences, and you gotta understand what they do to your return, because they significantly affect the amount that you walk away with, just as significantly as valuation, but they can be a lot more difficult to understand. So with that, I will turn it over to our panel for any further comments.
I think you did great.
What's
That
that?
was a great job.
I think you did a great job. I don't have much to add.
I would try and avoid these at all costs in your cap tables. I mean, at the seed stage, we don't see them. At the A stage, I don't see them. And if I did see them, I'd just be generally pissed. So,
I think you see these terms if, two conditions. One, you're desperate, which at that point the investors will try to take advantage of you and take liquidation preferences of more than 1x, or they'll try to go for participation. Or you're greedy. You're trying to maximize valuation, so you have to trade off something for some of these things. So beware of that. Again, hire a good lawyer who will keep you out of this, keep you out of trouble. And then number two, I think a lot, the rule here is at an early stage is you want to be aligned with your investors. You want the economic incentive of the investor who's in your company to be as closely aligned with your interests as possible. And generally what that means is these terms are very simple. Simpler is better, no bells and whistles. Everyone will be happier if you can kind of adhere to that rule.
Yeah, I guess this is the term that's like the #1 indicator of, like, back to my earlier comment of like what are your shares worth, and it's the #1 reason that even if you raise at a higher valuation, you know, your shares are still probably on an expected value basis worth the same. It's just a higher number multiplied by a smaller fraction, right? And so yeah, it's probably a good indicator if everyone you're talking to is getting aggressive on liquidation preferences, or even some people that your valuation is too high that you're asking for, if you're trying to be a price maker, not a price taker.
I just asked one question of the panel, and I agree that you're not seeing these in Series A deals, but a multiple, I mean, I certainly would not be seeing a 2x multiple in a current Series A deal.
on the liquidation preference.
Liquidation preference, yeah.
I think, no, I don't think so. 1x non-participating is pretty standard.
Someone at the table said, I forgot who said this, and I think it's really important. The terms that you set at the beginning tend to persist through subsequent rounds of funding. So if you go for a higher valuation, but you trade off some of these rather onerous terms, that next round, that next investor will duplicate this. And that's just a really dangerous trap that you want to avoid early. It could be at some point, maybe later stage, like your last round of funding, and you just like, you need another 20 million bucks. Maybe at that point you trade off, okay, I'll give you a 1.5x participating, and you can trade that off versus valuation, but avoid that really early on. Like you want to start off with some good habits, good hygiene, and keep it simple, and avoid these bells and whistles, because those may come in later, which is fine, but don't start it off that way.
I agree. I think in mid to later stage, there's structure in everything. Just put that out there. I do think starting the right, simple way is the way to go. You press on valuation, more structure. Typically, just so you understand, there's typically about a 25% delta between participating preferred and regular convertible preferred. So it's an economic sweetener. If the valuation, just do the quick math in your head of, you want a higher price, fine, it's going to come with this. I think multiple liquidation preferences are usually when it's bad situations, not up into the right or progressing with competition. Standard is convertible 1x preferred. From our perspective, frankly, we trade away terms for ownership. We find great companies who actually, our mandate as a firm is like get as much ownership as possible in the company. That moves the needle for our fund. So we actually buy common stock, and we buy out people on the cap table that want to sell. For us, we get paid for the upside, not the downside, so we trade away terms for better ownership and better price.
So I have a question actually on that. So does that end up like messing people up because you're pricing common shares, or?
So
Is this allowed?
great question. So we make sure that all the options that need to be issued are done before a transaction like that happens. And what Ali's asking is that if someone comes in as us to set a price, it is one data point in a 409A valuation that can set a higher strike price, make your common less valuable, so to speak, but it's, in any
Does it hurt
conversation,
future employees?
we always have that conversation before we go down that road.
Does it make options less attractive for future employees though?
You wanna get a good price on it, so it depends.
Alright,
So for a lot of the unicorns that we talked about previously, the reason why they were able to strike deals where the valuations are $1 billion or more is because of these terms. I think a significant percentage of those deals are not your straight
Yeah.
deal terms. They have these bells and whistles to raise money at that valuation.
All right, we're gonna move on. Protective provisions, I'm not gonna say too much about this. These are veto rights that preferred investors get over significant actions of the company. Usually includes things like merger, sale, or acquisition, financings, repurchase of stock. It's important to recognize it can be a significant shift of control. As these guys have been saying, what's most important is to get your interests aligned with those of your investor. I mean, above all else, that's what you want because you're in it for the long term. Protective provisions are an important part of the puzzle, and it's important to get them right. You guys want to say anything about it?
my only comment is if you're doing an alternative lending platform as your company, be careful on the debt financings because you're probably going to spend like 3 to 5 months trying to get a debt financing so that you can finance loans. And if your VCs are not cool with it, then you're probably not gonna end up being cool with it. That's my thought.
I think these terms are important, and you certainly should pay attention to them, but the reality for most entrepreneurs is that, I think most entrepreneurs, you don't realize, you actually have a lot more control than you think you do. Like, us VCs, we're not running the business, right? If you feel like someone comes and offers like $15, $20 million to buy your business, and you really want to take that, it's highly unlikely that investors are going to block that. Because what else are we going to do? We're like, okay, fire you, I want to be the CEO of this company? No. Like, the reality is, de facto, entrepreneurs, at least good ones, have a lot more control over what gets decided than not. So I think sometimes people obsess about these terms, but in reality, like, and I've been doing this for 15 years, I don't think any of these things have ever, we've never taken a board vote. Like, okay, it's like three versus 2, and we force the entrepreneur to do something. It just doesn't happen. It does happen, but it's very infrequent. A lot of times it's a conversation, it's a debate, it's a discussion, but at the end of the day, the entrepreneurs have a lot of influence on what happens. So don't underestimate your ability to influence that decision.
So maybe even to that point, the biggest implication might be you do something your VCs don't want you to do because you really do have the power. Sort of your point, it's not like the VCs are going to kick you out and become the CEO of the business, but it probably is not, pick your battles on these, right? Like if you do something that all your investors don't like you've sort of lost some social capital. But in credit, you always respect the borrower. This is the same version of that, but in equity, you always respect the entrepreneur if you're a VC. So they have more power than you think.
All right, we'll talk about anti-dilution rights for a minute. Probably a more important term now than they were a year ago with the down rounds that are ahead of us. I'm not going to go too much into the details, but this is basically protection that investors get. So if there is a future round that is at a valuation lower than the valuation in that investor's round, they get some type of adjustment in their purchase price to account for the down round. They will basically get a better conversion price, so when they convert, they will get more equity in the company than they would have otherwise gotten. It can be a more stringent formula or a less stringent formula, but the bottom line is it's a way that investor increases their equity stake because of a lower future valuation at the expense of the founders. Basically, that if the investor is getting more, it means the common holders are getting less. And again, it can be a more strict formula or a less strict formula, but it hurts it affects the common holders And in the environment we're in now, it's something to be aware of because it can make a significant difference.
I'm just gonna add in what I call the golden rule here. He who has the gold makes the rules. So if we're a seed investor and we've got, broad-based or narrow-based anti-dilution protections, and the best Sand Hill Road investor comes out of nowhere and says, I love your company, and I own about 10% of it, and I can invest up to the highest of the, pretty much the highest 9-digit number, or 7-digit number that I could choose, right? So he's basically effectively valued the company. And our broad-based anti-dilution protections make that deal impossible from a share perspective. What do you think is gonna happen? Those rights go away, and that investor gets the deal they want.
Because you said okay, because you wanted to happen.
No, because we don't get in the way of our founders when it comes down to deal terms being a critical factor and hurdle they need to get over for success.
Legally,
Right.
or because you're good people? Good people.
Well, it's reputational risk. I go against a founder and I call up a lawyer and I say, no, I want my rights. How many founders do you think come back to me after that? The good ones, I'm pitching them to get into their deal, right? It's their deal, and it's their company. This is your company you're building. We're here to support you with capital, and these terms are simply meant to align incentives. And the minute they're not doing that, they malfunction in a lot of ways. Important context.
Okay, our last term we're going to talk about is redemption rights. This is a term that is rarely used and certainly not seen in all deals. It effectively functions as a hammer at times. It gives it can give the investors an exit. Basically, it's a right that says that if they have not gotten an exit within often 5 years, the company will buy them out of their position often over 3 years, 1/3 over 3 years. As a practical matter, I'm trying to remember if I've ever seen this term get exercised. It's extremely rare. To the extent it has any value at all, it is something that is in the background that the investor knows they could call upon if ever they need it. The founder knows they could call upon if ever they need it. It's basically a way of keeping people's interests aligned that sooner or later there's going to be an exit. Guys?
I guess it's like a question for you guys. I don't know when that would happen. Is it like if you're on your last fund, you can't raise another and your LPs want money back?
I think I've only heard of it once with Oak, where they were getting toward the end of their fund cycle and they threatened to use it as leverage to force something to happen. But this is a term that happens very, very infrequently. So pay attention to it. Have something that's plain vanilla. Ryan probably has a better view of that. actually.
Yeah, so in reality, it is a forcing function to have a conversation about what to do. All of us on this panel are paid to make a return for our clients, who are both entrepreneurs and the investors who give us money. It is there to force a discussion. You need to get out, and there's ways to do that. And the reality is, entrepreneurs run the business. We're minority investors with negative consent rights. We can't control anything. We want to do everything to support and build the business. It's rarely ever called. In the situation, though, that an entrepreneur, let's say, has gone off the reservation and doesn't respect that the investors need to get liquid somehow, that's when that term would come into play. We've never used it, but it's there for a forcing function. Because literally, if anyone would use it, I'll tell you the company is not in a situation to buy any capital back. So it's sort of moot.
Well, it
in
can
its-
promulgate
in
a
its
sale.
design.
It can promulgate a sale, is what it can do.
What it'll do is start a process around trying to market the company. I don't know if it'll even get you a sale, that's the point. You can't
It's
force
leverage
it.
to have a conversation.
Yeah,
It's
and-
a chip at the table, so they have to talk to you.
We're
gone.
we're here to manage portfolios of companies, so we're not gonna jump in, and that's the leverage that, Ellie's point is spot on.
This actually raises a really interesting other question, which I think is actually probably more important, is in the last few years, it's been become very popular to raise venture capital. Like you see it on HBO, you see it on Shark Tank and stuff like that. The reality is most businesses should not raise venture capital. Really. Like, you shouldn't raise venture capital unless you think you just have a kick-ass business that's gonna generate hundreds of millions of dollars of revenues in a relatively short period of time. If you're gonna be, if you're not that, if you're gonna kind of grow 20, 30% a year, which is great, a good business, don't raise venture capital, because venture capital is really expensive. There's a lot of bells and whistles attached to it. There's a lot of constraints that you bring on yourself. You have to deal with VCs like ourselves, which can be unpleasant. So avoid it unless you absolutely believe your business is one of those few businesses that actually can really create a new market, dominate a new market. But venture capital is not the only way to fund your business. There's other ways of raising it. So just think about that. Don't think that by default, like, hey, I got a new business idea, I should go raise venture capital, because oftentimes that creates more constraints than maybe what you want at that particular stage.
Totally agree.
All right, so we follow with a list of other Series A terms that we're not talking about today, but for the sake of completeness, I have put them up there. I will give you the panel a chance. Is there anything on this list you'd like to pause on briefly before we move on?
Don't underestimate Rofer. You might look at Rofer and be like, oh, well, you guys could just match my next price. Rofer has like a super chilling effect. If I'm an investor and I see Rofer, this is like for credit deals that we do, and I see that you have Rofer on your terms, your other investor has Rofer, it's not worth my time to do all the diligence, because my assumption is they're just gonna come in and take the deal from me at the end anyway. And so you might, I think entrepreneurs underestimate that deal term. I don't know if equity is much, but see that.
I'm kind of curious to get your guys' feedback on founder reverse vesting. I don't deal with it.
What is that?
Okay, yeah, so founder reverse vesting, I see a few. That's the notion that when the investor comes in, they want to know that the founders are incentivized to stay with the company for a certain period of time, often 4 years. And they will impose a right, that an obligation, that if the founder leaves the company earlier than, say, 4 years, they have to forfeit a certain amount of their equity back to the company. It's a way to keep the founders incentivized and with the company for the long term. And it's a way that if a founder leaves early, God forbid, they give up some equity which can be used to incentivize someone to come in and take that place. Now, for the investor, it's a bad result if a founder leaves for all sorts of reasons, and being able to put someone else in that place is not necessarily an easy thing to do. Founder reverse vesting is how you deal with that issue. So I'm sorry, Warren, I think you were going to.
Yeah, you absolutely need to have it for early stage. I mean, it's an uncomfortable truth, but it's important. There was an example here about 5 years ago where an e-commerce company raised $20 million from a very reputable Sand Hill Road investor. One of the co-founders was, raised the money, owned 25% of the company, and literally a day or two after the round closed, he left the company. So he, investor, you invest $20 million in a business, and suddenly one of the key employees leaves and takes his 20 to 25% ownership. That's not quite fair. So there's a reason for this feature, and it's exactly that you're aligned along with the executive team and investors that you, for some period of time, you're going to be building the company together. Otherwise, don't raise the money. Raise a lot less.
Yeah, I absolutely agree with that. I mean, the investors I represent, the angel investors, in particular, who may be a little more squishy about deal terms, I would strongly advise them against ever getting into a deal without reverse vesting. And if the founder isn't prepared to agree to it, my advice to them would be probably pass on that deal. They put too much at risk.
No, but my founders already have that already built into their contract. So on our current equity split, do you require that at each stage? So going into Series A, an additional 4 years, or do you accept already pre-existing terms?
Time served.
Yeah.
I mean, it depends on, like, there's a lot of companies that have sort of been sputtering around for 3 years, and finally they decide they want to become a venture business. So probably, like, I guess I'm speaking for you guys, and you guys, but I'd imagine if you put money into companies from that point forward, right, that's when the deal started. Also, like, it's a brand new company when there's suddenly $20 million in the business, compared to when it was like, you know, $1 million business selling widgets.
It's a brand new business if you put another $1 million or $2 million in the business. Right? If you're bootstrapping it, you know, friends and family money, maxing out credit cards, and next day you raise $2 million. It's a different company, right? So why shouldn't you be reverse vested? You know, the company is very different once you have $2 million in the bank as opposed to the day before.
It sets you up to take institutional venture money up the food chain as well. So this is all part of structuring yourself because you believe that you need venture capital, right? And venture capital for high growth and really nothing else. It's a high growth mechanism.
So one last word on reverse vesting, I'll say, sort of goes a little bit outside this conversation, but when I represent founders, 3 or 4 founders that come in, I will have the conversation with them that they should strongly consider reverse vesting before them. You know, for the same reason, you don't want to, you know, start down a path with a few people, and you're all, you know, going in this together, and then one person leaves. And it's not necessarily it's not like they just decided I've had enough, but things change. And you know, a family member gets ill. There are all sorts of life circumstances change, and you really need to keep yourself aligned with your co-founders. So we will end with each of you, last words of advice for early stage companies that are raising money now.
Yeah, listen, stay passionate in everything you do. The people that you recruit around you is probably one of the most important things, and then your mastery of your market. But vulnerability to say, when you don't know an answer, you don't know it. And that's great in terms of just being a balanced entrepreneur, in my perspective.
So companies that achieve product market fit rarely have trouble raising growth capital. Companies that focus on growth capital before product market fit rarely ever work. And the key is you want to show up to the investor's office saying, hi, my wheels are falling off because these customers are lining up around the block. And I need money to hire engineers right now so that I can count service people and really build out kind of on this demand that I'm experiencing. And I hear that you're good at doing that and helping companies do that. So I'd like to have a conversation. Don't make it a pitch. Make it, here's the demand. I'm trying to deal with this right now. If that's not happened to you, don't raise venture capital yet. Because if it doesn't pick up and grow, it's a world of hurt. Not from us, just generally.
Deals happen if there's velocity and things are getting better and better. So I think often people raise seed deals and like they promise the world, and I guess the issue with that is you have misaligned expectations of what you need to do to raise your next round of financing. People think that's going to work in their Series A, and the problem is in your Series A, people then go do diligence to make sure all the shit you said was true, and often people oversell. And like the best way probably to raise your Series A financing is like to tell the truth about something that's awesome, and then just prove that it's true over and over with all the data that you get the person. And I think that the deals that we see that get done are not the ones where you had an awesome first meeting. It's where you had things just kept getting better over time, and there was real velocity there. You hit a milestone while you're talking to the person, stuff like that.
So Ryan talked about what they look for in terms of their best CEOs. And I think one of the attributes we look for is someone's grit or ability to grind. Because being an entrepreneur is like one of the loneliest, but also one of the most satisfying things if you get it right. But it's a long journey. So as you think about raising money and who you hire, think about who you're getting in bed with. And, these terms all matter. They're super important. Again, hire a great lawyer to keep you out of trouble and make sure you get a fair deal. But don't focus exclusively on that, because there's other things about, there's the people aspect of this that you have to pay attention to. Because there's very few overnight successes. You will be at this for many, many years.
So you want to be able to surround yourself with people that you can trust and get support from.
All right, and I think with that, we will wrap. Ryan, Elliot, Ollie, Warren, let's have a big round of applause. If you'd, Eric, is there still food and drink out there? Okay, well, there should be, so feel free to stay. These guys will be around for a little while.